This is the Alhambra Investments Weekly Market Pulse with Joe Calhoun. And Joe, I want to start off with a quote you put in your report this week from Friedrich Nietzsche. You said, "In individuals, insanity is rare, but in groups, parties, nations, and epics, it is the rule." So is that kind of how we started 2022 in the market?
Well, I kind of think we've been there for a while, actually. I mean, if you look at some of the things out there that have been attracting money, like, the crypto space and NFTs and now Web 3.0, which Silicon Valley's VCs are just throwing money at, the metaverse and all this stuff. I think the crazy part has been with us for a while. I actually think that the beginning of 2022 was more a reversal of the crazy. We got some things that were a little bit more rational, but look, you never know about these things until you got some hindsight. So we'll see if this move at the beginning of the year has any legs to it.
Well, I was going to ask you if all bets are off from 2021, but you kind of answered that question. Last week we saw value over growth. Treasury yields were up, credit spread steepened, tips were up, crude and natural gas was up. Isn't that kind of an indication that investors think growth is going to go up?
Well, it's funny. It wasn't really characterized that way in the press. I think the press was more thinking along the lines of Fed action, or that the Fed was going to be more aggressive. But when you total it all out, if you don't know what the press is saying, and you just look at the markets, it looks like that growth expectations are rising and that inflation expectations are falling, because that's what the market did. We saw a rise in the nominal 10-year rate up to 1.8 this morning, actually. 175 last week, 176, whatever the number was. But the more important thing from our viewpoint was that real rates went up. That to us is a big deal. If you had real rates stay the same and nominal rates went up, that would be a rise in inflation expectations, which is not a good thing. But in this case, we actually had real rates go up more than nominal rates, which means that inflation expectations actually fell. And, inflation expectations, if you're looking at the TIPS market versus the nominal bond market, they peaked a couple of months ago. So the real question is, can you see a continued rise in real rates, which is an indication of a rise in real growth expectations? I don't have an answer for that. I don't know, because I don't know how bad is this Omicron variant going to affect the economy. We're seeing a lot of people call in sick. I do know that. There's an article I read this morning about 5 million people calling in sick last week. I haven't really seen the impact here in my town, but that doesn't mean anything. We're a small town. So, we've seen some in the airlines, where airlines have been canceling some flights because they don't have flight crews and so forth. But so we don't know what the impact of that's going to be. It does look like it's going to be pretty quick, at least if South Africa is a template. But look, it is what it is. Like I said, I've always said I take this stuff at face value. If the market says real growth expectations are rising and inflation expectations are falling, well, I'm going to take that at face value and say that's what it means. I will say this. It was really strange that this all happened in a matter of 1 week, because it was like the calendar flipped and everything changed. And I'm not sure what it is that people saw that made them make that change. I can't get inside the head of all the people trading this market, so I don't really know. But it is very, very interesting.
Talk to me about the dollar last week, because that's something we watch very closely too. And what happened, and what does it tell us?
Well, listen, I would have expected, if growth expectations are rising, that I would have expected to see the dollar be strong. Generally, currency movements are about relative growth expectations. And I don't think we saw any big change in the growth expectations outside the U.S. At least at least from an anecdotal standpoint. Maybe we did in the bond markets, but not necessarily in any way think about it. Is there anything that changed in Europe that was that positive? I don't think so. So I think the difference, the fact is the dollar didn't go up last week. It was up a fraction, a 0.1% or something like that. So it didn't go down, but it didn't go up as I would have expected. And one of the things that, after having done this for 30 years, one of the things that gets me on point is when things that I think should happen don't, or, vice versa, I suppose. It's like, if you own a stock, for instance, if you own a stock and there's good news released and the stock doesn't go up, and that tells you something. That's kind of what we got with the dollar last week. We got good news in a sense, and the growth expectations are rising, but the dollar didn't respond to it. So I think what that is really is that it's a response to the inflation expectations. If inflation expectations have peaked, if inflation truly is transitory or whatever term you want to use, I don't really care, then that would imply that maybe the Fed doesn't need to hike rates as many times as people are thinking. In the meantime, we got a higher and hotter number in Germany or in Europe more generally. Inflation is running hotter there than people have expected. And so now there's some expectation starting to be built in the market that ECB will have to do more. So I think it is in this case with the dollar, maybe it is about the difference in monetary policy or perceived what's going to happen in monetary policy. Listen, momentum peaked on the dollar, back in December, early December. So it may be that we're in for a reversal here. We'll see. I don't want to jump ahead. I don't try to anticipate. Right now, dollar still in an uptrend. It's sitting right in the middle of the range that we've been in for 7 years, and that is a fairly strong level for the dollar. So the only thing that flipped last week was that growth is now in a rising mode because expectations are rising.
Well, and on our gauge, that was one of the things I wanted you to talk about because you're moving us from that area of growth falling and dollar rising to growth rising and dollar rising. So what does that mean in terms of portfolio?
Yeah, well, first of all, let me just say this. I should have made this switch a month ago. I didn't, and I can't change that. But it was a holiday month, and people, I think, kind of get distracted, and I'm no exception. I think we should have made this shift already because we had a pretty good size move in the 10-year note yield, and I didn't really acknowledge it. What I really wanted to see, though, was that we broke above those spring levels at 176 and the 10-year, and we did last week. So I think you've got to flip this now and say, look, 10-year note yield and real rates are in an uptrend. You got to acknowledge that growth expectations are now rising. What does it mean? Well, in a rising growth, rising dollar environment, you would generally want to favor, well, let's take rising growth first. In a rising growth environment, you want to be, for instance, one thing would be you would want to favor corporate bonds over treasuries. You would want to favor industrial commodities versus gold, for instance. In a rising dollar environment, too, you probably want to generally favor growth stocks. Now, that's a bit of a problem right now because growth stocks are getting clobbered. I will say we're not going to make changes immediately. We tend to take our time on these things. We're not rushed traders. But if the dollar stays in an uptrend, I would think if the dollar stays in an uptrend and growth expectations continue to rise, then the growth stocks are probably going to come back some. I know that's contrary to what a lot of people think these days. They think that if growth looks good, that people are going to buy value stocks. Look, that may prove true. We know that these things are not carved in stone. In the early 80s, with the dollar rising, value outperformed. So that can happen. And we're going to be attentive to that. We're going to watch momentum and so forth. And we've got an exposure to value right now. So look, if that continues, if that value versus growth trend continues, we'll stay with value. But in general, in a rising growth environment with a stable to rising dollar, you want to be fully invested. And that's what we're not right now. We're not fully invested. So we're going to have to figure out ways to figure out how we get that way. Now, look, if the dollar gets in a downtrend, it opens up a whole bunch of things for us. If you get in a rising growth, falling dollar environment, then you could be in a situation where international is going to outperform. And it's very interesting to me that we've seen international outperform last week, including emerging markets, by the way, which I don't think anybody expected. So right now, there's a little bit of, there's some hints here that maybe the dollar's peaking, but we can't make that call until we really see something on the chart that says the trend has changed.
Three things I want you to hit quickly. Big miss on employment numbers last week. What about that?
I don't think it really makes all that much difference. The unemployment rate was good. Participation rate didn't really change. That's fine. We'd like to see it stronger, but it has recovered pretty quickly from the lows. The household report was much, much better than the establishment survey, which is 2 straight months. And listen, I think part of the problem with with the establishment survey is the response rate. Look, these are surveys. They actually call companies, in this case, in the establishment survey, and the company has to answer the phone. They haven't been answering the phone at nearly the same rate they were prior to COVID. I think there's an obvious reason for that. It's a lot of people not there. So the household report has a little bit better response rate. It's fallen too, but not nearly as much as the one for the establishment survey. So I think there are some survey problems here, and that's why the establishment survey hasn't been working well. But in general, I don't think it means all that much.
huge JOLTS number last week. Just an incredible amount of people quitting their jobs.
Yeah, the quits rate made another high. Job openings actually fell a little bit, and that looks like it peaked a couple of months ago, but it's still at a very, very high level. Look, the quits rate is very interesting. I think the quits rate is primarily about low-end workers, leisure and hospitality, accommodation and food service. Those have seen big jumps in the number of people quitting. Now, those jobs always have had high quits rates, don't get me wrong, but they have jumped quite a bit. We've seen some shift too in manufacturing, but it's in the non-durable side. You know, things like I don't know. We had a strike, remember, at what is it, Kellogg? So you know, food manufacturing, things like that. We've seen some quits there too. That would also include meat packing and so forth, which is kind of obvious. But I think really it's more a low-end phenomenon than anything else. And the bottom line is this: people are able to quit that job serving tables and go work for, say, Amazon and make a hell of a lot more money. Or they can go to, you know, Walmart or someplace like that where they've got a new higher minimum wage and make more money. Until the restaurants and the other service businesses on the low end, until they step up and raise wages, which is starting to happen, by the way, they're going to keep losing workers. So that's a big part of that quits rate. But there's also an underlying, just an underlying trend here. All professions, really, except for a few, are seeing a rise in their quits rate. How that is going to affect the economy long term, I think, is the big question for the near future. The next 10 years and what happens in that next 10 years is going to be very, very interesting. And I think this is a big part of what the change is. Look, these pandemics, things like this, big events, they change things permanently. And this one is no different. We'll see. I don't know what the outcome is going to be. Working remotely and working from home and doing all these things may have a profound impact on the economy, but we really going to have to wait to see how it plays out.
Last report, exports, good number last week.
Yeah, look, we've seen, I saw, a few people had said something a few months back that exports didn't look that great. And that was true at the time, but it's not anymore. Exports did an all-time high in the latest report. It just goes to show that the perception that the rest of the world's not doing that well maybe isn't as well-founded as people think it is. Look, I'm not saying the global economy is great, but it's not that terrible.
You ended your report with something that we know very well here in the South. At this time of year, you got all kind of people making predictions and prognostications and trying to figure out what's going on. And you're in South Carolina, I'm in Tennessee. And to those people, we just say, bless your heart.
Yeah, I included that. My grandmother was the master at the bless your heart thing. Now, people that aren't Southern probably don't know what this means, but I will tell you, it is neither a compliment nor a blessing. It is a way for people in the South to basically say you're an idiot without saying you're an idiot. My grandmother was the master at it. She would say, well, bless his heart, he doesn't know any better. Or someone in the room would say something dumb and she would pipe up. And my grandmother, by the way, was not a real educated woman, but she was smart as a whip. Somebody in the room would say something stupid and she'd say, well, bless your heart. And everybody in the room that knew her knew what that meant, except for the person that she said it to. So that's kind of the way I feel about these prognosticators, these people coming out with these outlook pieces about what the next year is going to hold. I have a crystal ball, man. I don't know what's going to happen. So I just think, well, bless your heart. Isn't that nice? I'm just so glad that you wrote that. And move on. Don't waste your time reading those things, but do spend a little bit of your time and download our year-end review and piece for 2022. Look, we don't make predictions. Well, you do make some observations, and I hope they're interesting to you.